Hello and welcome to this comprehensive tutorial on presentation and demand under guarantees and counter guarantees, focusing on Urdg 758 and ISP98. Whether you are a banker, trade finance professional, or someone dealing with demand guarantees and standby letters of credit, this video is designed to provide you with in-depth understanding of the topic. Today, we will be discussing several key areas, including the requirements of a presentation under counter guarantee, the fundamental principles of Urdg 758 and ISP98, and how to handle demands under guarantees that are not explicitly follow any established rule. We will also explore the proper way to deal with incomplete presentations, the possibility of making corrections, and the concept of partial and multiple demands under different regulatory frameworks. By the end of this video, you will have a clear understanding how presentations and demands work within these systems, the potential challenges that can arise, and how to address them effectively. So, let's get started. To begin, let's talk about counter guarantees and how demands work under them. A counter guarantee is essentially a secondary guarantee issued by one guarantor in favor of another, ensuring that if the second guarantor has to make a payment under a guarantee they have issued, they can then demand reimbursement from the counter guarantor. The requirement for making a demand under a counter guarantee are largely the same as those of a direct demand guarantee. However, there is a crucial difference, which is outlined in Article 15 of Urdg 758. Unlike in a regular demand under a guarantee, a demand made under a counter guarantee does not require a statement that applicant has breached the underlying contract. The reason for this exception is that there is no direct contractual relationship between the counter guarantor and the applicant. Instead, Subarticle 15b specifies that when making a demand under counter guarantee, the guarantor must include a statement confirming that they have received a complaint demand under the guarantee they issued. This means that the counter guarantor must pay the demand if the guarantor confirms that it has received a valid and complaint demand from the beneficiary of the original guarantee. However, under Subarticle 15c, the requirement to provide this statement can be excluded if both parties agrees. This flexibility allows for more streamlined process in certain cases where the parties prefer to operate without additional documentation requirements. Another critical point to consider is the timing of the demand. If the counter guarantee specifies that reimbursement will be only made after a guarantor has actually paid the beneficiary, the guarantor must wait until they have settled the demand before requesting reimbursement from the counter guarantor. On the other hand, if the counter guarantee does not have this restriction, the guarantor can demand payment as soon as they receive a complaint demand and indicate this in their own demand to counter guarantor. One common concern in counter guarantee is whether the counter guarantor can delay payment while they independently verify whether the original demand was actually complied. The answer is no, according to Urdg 758. If the guarantor's statement confirming the compliance of the demand is made in good faith, the counter guarantor must honor the payment without delay. This prevents unnecessary delays and ensures that demand guarantees and counter guarantees function effectively and efficiently. Now let's move on to the issue of applicant signature in demand guarantees and standby letter of credit. Sometimes, a guarantee or standby letter of credit might include a requirement that the demand document must be issued or countersigned by the applicant before payment can be made. While this may seem like a reasonable precaution, it can lead to significant problems in practice. The primary issue with requiring an applicant signature is that it gives the applicant control over whether a demand can be made. If the applicant refuses to sign, the beneficiary is unable to make a demand, even if they are fully entitled to do so, This completely undermines the purpose of a demand guarantee or a standby letter of credit, which is supposed to provide independent security to the beneficiary. For example, imagine a construction company that has received a performance guarantee from its bank in favor of a project owner. If the guarantee states that any demand must be signed by the contractor before the bank will process it, the contractor could simply refuse to sign, making it impossible for the project owner to call on the guarantee. In effect, this defeats the entire purpose of the demand guarantee, which is meant to be independent of the applicant's action. For this reason, it is best practice to avoid including applicant signature requirements in demand guarantees and standby letter of credit. Now, let's consider what happens when a guarantee does not specify any governing rules, such as Urdg 758 or ISP98. In such cases, the requirements for a demand depend on three main factors. First one, the specific terms of the guarantee. Second, governing law applicable to the guarantee. And general international standard practice. Since many legal systems do not have detailed regulations on demand guarantees, most of the requirements come directly from the terms outlined in the guarantee itself. This means that if a guarantee is vague about what document need to be presented, disputes can arise over whether a demand is compliant or not. A common issue what arises in these situations is how to handle an incomplete presentation. If a guarantor receives a presentation that lacks some of the required documents, they face difficulty. To avoid these issues, guarantees should clearly define what documents are required and set clear rules for how demands will be examined. If no rule is specified, a simple demand for payment before the expiry date is usually considered sufficient to the guarantor to make a payment. Turning now to ISP98, Rule 3, which provides detailed guidelines on how presentation should be made under standby letter of credit. First, a presentation must always be made directly to the issuer of the standby letter of credit and not to an agent or an intermediary. Additionally, the presentation must be made at the place specified at the credit. If no location is specified, the presentation should be made at the place of issue. A presentation must be made before the expiry date of the standby letter of credit and must clearly identify the credit under which the demand is being made. It must also be submitted in the required format, whether that is paper or electronic. One important rule under ISP98 is that if the original standby letter of credit is lost, the issuer is not obligated to replace or waive the requirement. This can create challenges to the beneficiaries who lost the original document. If so, it is always advisable to keep careful records. Partial and multiple drawings under standby letter of credit are permitted unless they are explicitly prohibited by the terms of the credit. This means that beneficiary can make multiple demands for payments under a credit as long as the total amount does not exceed the credit limit. That brings us to the end of this detailed tutorial on presentation and demand under Urdg 758 and ISP98. Today, we covered the key principles of counter guarantees, discussed the importance of avoiding applicant signature requirements, examined the complexities of guarantees with no governing rules, and explored the requirements of making a presentation under ISP98. I hope this tutorial has provided you with valuable insights into the complexities of demand guarantees and counter guarantees. If you found this video helpful, please don't forget to like, share, and subscribe to our channel for more in-depth discussions on trade finance and banking regulations. Thank you for watching, and I'll see you in the next video. Till then, take care. Bye-bye.